Thanks for joining us today, folks. For those that don't know me, I am Ian Lane. I'm the Executive Director with the Northern Ontario Angels, and really excited to have this great panel, open discussion around angel investing with two good friends and experts within this realm. Again, just to talk about this series, it's the second one that we've done within that we're calling Investor Insights. The first one we did back in the earlier new year with two other investors, and then we're continuing the theme and just really trying to demystify angel investing and raise some capacity around the work that we do as the Northern Ontario Angels. So as we start, I want to recognize that Northern Ontario Angels are present across Northern Ontario, and we acknowledge the traditional lands of the First Nations across the region, including First Nation communities within Treaty 3, Robinson Superior Treaty, Robinson Huron Treaty, and the Ontario portions of Treaty 5 and Treaty 3. We acknowledge the rich history of Cree, Ojibwe, and Métis people who have been here since time immemorial. For those that don't know about NOAA, we've actually been around since 2005. We are a pan-Northern organization, so we are in 8 chapter communities across the North. And I see Bryan nodding his head because I think he knows us from our founding days. That's almost 20 years ago now. But we're standing members of the Angel Investors Ontario, National Angel Capital Organization. We are non-for-profit, and we have a regional board of directors, myself, my great colleagues, Kim Wahoma Deshane and Taryn Basson, and then 8 part-time consultants across the region that work with investors and founders to help them become investor ready. So if you're a founder and you're looking to raise capital, you can go on our website, www.northernontarioangels.ca, and find our entrepreneur intake. You can fill out a form there, and then investors can go in through that portal for investors as well if you meet the criteria set out by the Ontario Securities Commission. So again, just to appreciate you taking time before a long weekend to join us, and really excited to invite Don Duval and Bryan Watson to share their insights on angel investing. Their time when they crossed over probably around 20 years ago in Toronto, and when the Leafs were competitive. Anyways, sorry I had to do it. So without further ado, I'd like to introduce Don for those that don't know him. He's a strategist, CEO behind NORCAT here in Sudbury. Brings over 2 decades of transformative leadership experience, driving force behind NORCAT's evolution into a global leader in training, mining, technology, and innovation, and consistently has delivered tangible results and expertise that spans multinational corporations, tech startups, academic institutions, and government worldwide. Don's been an amazing friend to Northern Ontario Angels. I think a lot of the angel network here within Sudbury and expanding out throughout Northern Ontario is in large part to Don's leadership. So thank him for his continued influence on our organization. As I mentioned, our other guest, Bryan Watson, is now Senior Vice President of Business Development with Venbridge. So he boasts over 18 years of experience in facilitating capital access for Canadian SMEs. Recently recognized for his exceptional contributions to the Canadian clean tech sector with the 2021 Clean 50 Award. Bryan's leadership extends to numerous board positions, including the National Angel Capital Organization, and he brings a wealth of expertise in funding programs, advisory roles across the government levels, and invaluable insights into the financing landscape for burgeoning ventures. So welcome, guys.
Thank you.
Good to be here.
Yeah, awesome. Thank you for being here. Just wondering if you can take us back in time a little bit and let us know how your paths intersected in the earlier days of Mars and NACO, and where angel investing played a role in supporting the growth of that ecosystem, and if you're seeing similarities in other ecosystems and features, and how Northern Ontario might be different or stand out in other ways.
Yep. You want to start, Bryan? Bryan, you go ahead, and I'll share my perspectives.
Sure. I think the first time I ever met Don was at something that, if I remember correctly, we had convened called, the ecosystem had convened called the Fourth Pillar Council, which was basically a bunch of the acronyms, mostly newly minted, including Mars. the RICs, RINs, SINs, PINs, and FINs, regional innovation networks, sectoral innovation networks. We used to have those, federal innovation networks and provincial innovation networks, trying to figure out how everybody played in the acronym soup together. This was at a time when Mars was really just beyond the pit on College Street, but still very early in its life cycle. The building was there, which was good. So it had moved along. But the Ministry of Research and Innovation had just launched the market readiness program, which had the BMEP program at Mars, the Ontario Center of Excellence at the time, Investment Accelerator Fund at the time, which is now at Mars, and the often forgotten third leg of that stool, thankfully, because we just got to get work done, which was the Angel Network program, which I was at the time running NACO, the National Angel Capital Organization, and we incorporated AIO, which at that time was NAO Ontario, as a flow through from the McGuinty government for that Angel Network program to create and support the angel groups. And I say create, and then I say support, because they're really at that time, the Toronto Angel Group was in the process of imploding, and subsequently did and rose from the ashes as Maple Leaf Angels, which is great. But other than that, we as coalesced groupings of angels that put their sign out saying we're open for business. Other than that, there was a group sort of operating out of Ottawa and NOEG, Northern Ontario Angels, which became Northern Ontario Angels, and that was it. So, our mandate was really in Ontario anyway, to create more of those angel groups and support those that were already existing. And honestly, there's a long history of success in the North. It's been the stalwart since the beginning. It was the one group that I would say was functional and moving before any of the other groups were there. So my first trip up there too was Thunder Bay, and we were working with Jim Noble and showcasing companies to angels that flew up to meet the group and everything else. So yeah, it's been a long road, a lot of history.
Bryan, I'm amazed at your memory. It's incredible.
The acronym soup. I don't know. The neurons are probably a little rusty, but it sticks.
Yeah, I think the audience might find it interesting. So, as Bryan alluded to, we actually met when I was at Mars, and I was fortunate that I joined. I think I was employee number 13 or 14, what I still refer to as the golden era, end of 06, early 07, where I had a really interesting and unique opportunity to join an organization that still had yet to really, this being the Mars Discovery District, an opportunity to define the role that it would play to support the startup tech community, sector agnostic, not only for the GTA, but also it had a national mandate. It wanted to become the recognized brand globally that if you think Canada and innovation, you think Mars. And so it was a pretty aspirational mandate that was really outlined by our founder and then CEO at the time. And I had the operational role of EVP of strategy and operations to try to really articulate that and translate that into operational tactics over a 5-year plan. And what was really interesting is, there were very few entities, not only in Ontario, but across Canada at that time that were doing a lot of, I would say, creative work in terms of programs, services, and resources to help the startup community evolve. And we got a chance to try a lot of things. I was quite blessed with, autonomy to say, hey, there aren't a lot of benchmarks, especially in Canada, but, look down south, look at what they're doing in Palo Alto, and try to, derive as much insight as you can. And there's a whole variety of things I could talk about for that experience and journey. But what might be interesting, maybe there's 3 things I can highlight here that I think everyone would find interesting. In late 06, 07, Mars launched something called the Investment Accelerator Fund, and I was fortunate to be an investment director there for 5 years. And that was, really the formation of what now has become Canada's most successful seed capital fund, measured by a variety of metrics, including exits and liquidity events. And it really redefined, the notion of where kind of organized seed capital can play in encouraging and incentivizing high net worth individuals who serve as angels to kind of co-invest, to give a little bit more runway and cash to these, for the most part, pre-revenue, pre-capitalized entities. And that's become a really interesting thing that I can speak more about, especially in the context of, Northern Ontario, but more specifically in Sudbury, about an interesting vehicle that we've created that, again, if the moment presents itself, I'd be happy to share. The other thing that Bryan may not remember, and it really aligned to the notion of the angel landscape, in late 07, we actually created a very short-lived angel group called the Mars Angels.
Yes.
And one of the things that those who are prospective or existing angels here, especially those in NOAA, one of the learnings of this, I'll say short-lived, I think it lasted about 3 years. And one of the things I think is really important for, again, would-be or existing angels is that you have the opportunity to engage with like-minded individuals that share the capacity to invest versus an array of tire kickers who just want to hang out with you because it's cool and interesting. And as you're going through the journey and engaging with NOA and others, I think it's important that you scrutinize, who's in, are they accredited, do they have the capacity? And that was one of the things, if I reflect back, Bryan, you recall when we dissolved it, we just let a lot of individuals, engage in the group that really didn't have the intent or the spirit or the actual demonstrable capacity to make investments. And it becomes a bit challenging and problematic. And again, happy to dive into that. But the reason I share that is just knowing Ian and what he's created. I am just blown away at the level of diligence that the NOA has done to really reflect on, hey, if you want to be part of this non-fee-based membership where you can engage with like-minded individuals, know that it is very authentic in terms of the process to get in. And it's not hard, but it's an authentic process. And I think that was a really interesting learning back then. And then the other thing I will say, and I don't know, Ian, maybe this is a question for you, I can't recall. One of the most memorable things in my 5.5 years of being at Mars was something that Bryan created around startup drinks. And I will tell you, the camaraderie that you build by hanging out, if I can call it that, with like-minded angels who have the capacity, is unbelievable. And in full disclosure, I've made 4 pretty material angel investments over my term. I always do it strategically where I can offer more than just money. And without fail, each one of those 4 is with the same posse of friends, many of which I met at startup drinks. So just something to share, my experience and journey. But I share that knowing that this was stuff that, Bryan was and I were very much interconnected at a really unique time in the Canadian angel landscape.
It's funny. I on the startup drinks side, part of the reason we started startup drinks was at that time getting the deal flow. So getting the members of the angel groups together was one side, and it made a big difference to have the selection committee. Then you had to turn the deal flow pipeline on, and that wasn't as prevalent as it is today. It was it was sometimes a little harder to sort of rustle up that really good quality deal flow because we didn't have that ecosystem. We didn't have this sort of seething entrepreneurial spirit that we're kind of blessed to have now. It could always get better, but it's we didn't have that, so we actually started startup drinks partially because I might be in a pub anyway, but partially because it was a good way to get that deal flow turned on and a social network introduce folks without necessarily the expectation that they were angels, but they might be.
Yeah. That's awesome, guys. Bryan, I want to just pick up on something, and I'm going off script already here, but I knew this was going to happen. So you just mentioned have the investors come out, hang out. Don, I love your experience of those 4 investments with your chums from those earlier days. Have you guys seen the trends over the last 20 years around this angel investing, where you've got really compelling deal flow and you've got checks that are being written on a regular basis? Do the stars align really now, like at all times when there's synchronicity? I'm finding here, just maybe being a little not vulnerable, but sharing that we've got amazing investors, we've got amazing deal flow, but I worry about investor fatigue. There's a lot of work around how to awaken dormant wealth, how to get different people participating. You need that compelling deal flow, but how do you harmonize those 2 important parts of the pipeline?
That's the hard part. It really is. And it's a constant battle to make sure that you're bringing folks in, but not just for the sake of bringing folks in. You want to not just the current investors get less fatigued when they have exits. So, they rejuvenate nicely. So part of it is the market has to have those exits to put more capital back in, so that people can put more capital back out to companies with the excitement of, wow, I just had a great exit. Let's double down on angel investing. So part of it's the market. But yeah, no, part of it is bringing more folks into the fold, so that you're not always relying on the same people, and not always relying on the same people for the function of due diligence and deal lead and everything else. And that's a big area of fatigue that I always worry about, which is it's a lot of work to lead that deal. It can be a really rewarding, but it's a lot of work. And so you can burn those people out that are key champions. And that's one of the areas that I worry about.
Yeah, my reflections on that, if you look at Canada at a macro level, unlike any other time in our history, we have a huge amount of dormant wealth that is either, locked up in, I would say, kind of liquid assets or sitting in bank accounts. And with an aging population and this dormant wealth, I think one of the single biggest opportunities is finding creative ways to inspire and educate this wealth, irrespective of community. You can be in small town Canada, you can be in large metropolitan areas, and actively either through referral networks or some sort of form of solicitation to educate these individuals not only about good opportunities and deals, but you need to start at the grassroots and say, what is angel investing? And where I actually see more fatigue in, and again, I have absolutely zero data to validate this, but at a micro scale, more from personal experiences, especially in the last 5 or 6 years, I think there's more fatigue with high net worth individuals who don't know about angel investing, more fatigue with philanthropy, and I think that's a problem unto itself, and we need to think about that. Where a lot of these individuals being solicited to donate to XYZ charity and hope for the best, I think there's more fatigue in that. And I do think there's an unbelievable amount of dormant wealth that craves not only, investing in good deals, but having an active role, be it formally as a director, if it's a material investment, and or an advisor, or, maybe a contractor ESOP concept, whatever it might be. But, exploiting and leveraging this aging population with dormant wealth is going to require this proactive either educational mandate, or again, even if you take it to a micro level with the Northern Ontario Angels, have an event where everyone has to bring 2 friends that meet the minimum requirement, and you would be shocked at how inspired people could be. So I don't see, fatigue in the option of engaging new people. Maybe some of the current high net worth individuals, yeah, they're probably getting overly solicited and burned out. But boy, if we could tap into that 55 to 75-year-old cohort that are self-declared, again, no valid data on this, but self-declared burned out of the constant philanthropic solicitations, and say, hey, there's an alternative. And by the way, you can have a meaningful role. I think that's a huge opportunity in Canada simply because of the amount of dormant wealth and aging population.
Yeah, that's cool. I like that. And Don, I'm going to unpack that a little bit because, and I think Bryan, you and I have chatted about this a little bit as well when we bumped into each other last. But something that's different about Northern Ontario, and I think Northern Ontario Angels, is that I think the line between angel investing and philanthropy sometimes gets a little bit blurred. Folks are living in those smaller rural communities from time to time that see their investments. Yeah, they want their returns on it, for instance, but certainly that's we can't discount that. But they're seeing that the investment is almost community building, like it's building, it's reinvesting into community beyond the actual company and stuff like that. Are you like is that beyond anecdotal? Is that something that you guys have felt in your experiences interacting with Northern Ontario, and is that a bit different than what you've seen? Obviously focusing on the Toronto ecosystem, but Bryan, you've got a national reach with your NACO experience. Don, you have a national reach as well too. So just curious what separates us, and maybe give a little bit of a lens to entrepreneurs around that are on this call around how we are different and how to embrace that.
Yeah, I think it does straddle that. You do see it though in it, it is harder to see when you're in downtown, Toronto, where you have that sort of philanthropy. It's very structured, it's separated. But if I think of even the community in where I'm sitting right now in sort of the Bob Cage and Kawarthas region, if I think of some of the work that was done by the angel groups out down east, there's definitely a blurring of that line. I think one of the things that helps and maybe mitigate that fatigue that Don's talking about is the angel group gives a bit of structure around that. Like it's not just somebody pounding on your door all the time asking for money for a cause. It's giving a bit of structure around how that's approached, and that there might be a good business case, even if that case is more for social purposes as well as upside. So I it might be an urban rural, and just the amount of noise that you get in the urban center. And maybe I don't know, I'd probably get lynched for it, but lack of community in some cases, or more diverse communities that you're in too many different communities. When you're in your community, you get a little bit more of that proximity, which I think is a good thing.
Yeah, like definitively, Ian, your narrative of are the lines between philanthropy and angel investing blurred. I can tell you with surety there is a difference between urban centers and rural based on my experience. And the interesting experience, and I won't belabor it unless the conversation warrants, but the notion when we created this Catalyst Fund, which for those who are familiar with the IAF, essentially it's the IAF playbook, but we administer it through NORCAT and another partner. But the intent of this fund, which is a a traditional LPGP seed capital fund, is to co-invest alongside angels, meaning that the angels in Northern Ontario need to identify a prospective investment, come up with a term sheet, and then that venture is then qualified to potentially pitch to this fund. And the thing that I found fascinating and actually a bit concerning, and I'll kind of reflect on why I say that, the amount of early deals that we saw, some came to the fund, some did not, with high net worth individuals investing in companies in part because they want to sustain jobs for their children and their grandchildren by making this blurred contribution, was quite interesting. And again, I think I've shared this with you and Bryan. I didn't understand this notion of community and civil responsibility, if I can call it that, by these high net worth individuals. I couldn't understand it. I tried to understand it, and then I subsequently just gave up trying to understand it. I don't know why they had this passion to do so, because being from a really small rural town, I have no connection to that community. I don't know why, I just don't. But something in Northern Ontario is fundamentally different.
Hmm.
And so you kind of get through this process, and then you start to exploit it. But the challenges and the risks that we ended up encountering, we didn't promote it and celebrate it after a while, because it does become a bit concerning that if you have high net worth individuals, writing a check for 100, 150K, whatever it might be, who have a limited understanding as to the true meaning of an angel investment and what is entailed in that and what's required potentially, and then those deals don't work out, you run the risk as a facilitated angel group of bearing maybe some responsibility that we didn't take the time to educate and really make sure they fully understood. Because all it takes is a handful of stories to be shared of individuals going, I don't know, I went to this angel event and I invested. And I'm like, now I'm not sure what am I to anticipate. And you're like, yes, you don't have to necessarily bear the brunt of the responsibility. But we started tempering some of these high net worth individuals who are new to angel investing, saying, let's talk about what due diligence means. What questions are you asking? So you rise to the occasion of educating them and being forthright to say, yes, I get that you want to create jobs, but let's just take it one next level, because it will matter after a while if it becomes if you're not doing that diligent. So I just think it's a really interesting narrative between the notion of philanthropy and angel investing, and really, unapologetically ensuring that these individuals who are getting into it for the first time really understand the importance of potentially a board seat, or understand the notion of, convertible notes, or and it's fun. That's a fun adventure. Like Ian, your team has done an incredible job, and Brian's done this probably more than anyone. Like just spending a time with those individuals, and then they get it, and then they get involved, or they make a declaration that, oh my God, I don't want to do the formal due diligence. Can I just contribute my money to a fund and let the fund do it on their back? So
Yeah.
there's lots of vehicles, but it's an important observation that I saw, that we just kind of pump the brakes a little bit to make sure that we're playing a role to really ensure they understand what they're doing.
Yeah, that's great. Thanks, guys. Maybe I'll offer the audience, if you want to throw a question into the chat, feel free to do so. I think you're getting some trends and some nice themes coming from Don and Bryan here, but feel free to chuck a couple of questions in there if you have any. I'm curious, again, around the capacity and introducing new people to invest in, even in existing investors, with some of the changes. Like Don, you and I chatted about this recently, where safes, obviously, the instrument are seeming to grow in popularity, but convertible notes have been the backbone of angel investing in Northern Ontario. And is that a bit surprising, or maybe talk about how you engage and build capacity with new investors, and part of that education piece around these are the instruments that work and the time that goes into it, the peer based things, and maybe ways that we can build capacity around navigating the structural parts of the investment.
Yeah, like, there's kind of two halves to that. One, I would say there's kind of, core baseline educational resources that, NACO and NanoWay, like there's websites where you can clearly download templates to better understand, at a theoretical level, what constitutes these different investment vehicles, be it a SAFE, a convertible debenture, subscription agreement for direct equity. Like, they're not overly complicated, but what I will say is you can understand the theoretical part as much as you want, but at some point you got to jump and say, okay, this is a deal I like. And I could talk about the qualifiers I have for any angel investment on the seed capital and angel investment side. But once you commit to doing so, the hands-on, I'll call it real life, if I can use that analogy, of actually going through the process, engaging your own personal counsel, assuming you have, legal representation to navigate it, fully understanding it. The first time that I actually went through a transaction, I thought I was well versed in it. And then you go through the process and you're like, wow, there's actually some nuance to this that you really need to appreciate and understand. And so the being able to engage with those who can share experiences of their journey when you're looking at doing a deal. And again, we have a group called the Amigos, and we do it all together. There was one individual in that cohort that you obviously both would know. I won't share his name, but he was a very experienced, tried and true angel investor that helped me navigate negotiating my term sheet to make sure I fully understood exactly what I was getting into. So I find, for those who are would-be or those who have maybe only done one deal and maybe are still a bit uncertain as to, what rights you have and all the various clauses as a shareholder, it's important to actually go through the journey. You can do as much research as you can, but just know full well that it will evolve and you'll come across things that you never anticipated when you go through that.
The evolution is an interesting word there, Don, because if I think back to the first the ye old angel handbook that we did, white covered thing, 2005, 6, 7, 8, safes didn't exist. They weren't even in there. They weren't an instrument that were actually being used. So there's definitely been an evolution since then. It was basically prefs and convertible debt. So these things do evolve. The market evolves. It's constantly in flux. It's probably more of a buyer's market right now and so you might be able to dictate different terms than you would have 3 years ago as an investor. But there definitely is an ongoing evolution. One thing I will say as part of that evolution is, and safes and convertible debt, it has impact on, is I've seen a real evolution, and it could be my bias because I guess that hat, the Venbridge hat, I'm working on the debt stack side of things right now. And so I've seen a huge evolution in the last 2 years, especially the last year and a half, since equity got a little bit tighter, in the amount of education that we've had to do around managing the debt stack and how that interacts with convertible debt, how that stacks, under the GSA for, your bank of preference, how a, shred tax credit financing, how, how, what a priority agreement is, and how you get people in, and how you have to sit on that capital stack. And so, before there was, in the last couple of years, there was just a default to equity. And now there's a more considered approach of, okay, a rebalancing of that sort of debt and equity and an evolution there. So the only thing I would say is in terms of convertible debt versus safes versus prefs is that all valid instruments, always think about that next round of capital, because if you end up putting in really weird and wacky terms in there, so there's things like, out there's secured convertible debt, which is sort of quasi equity, quasi debt, but secured on the GSA. Well, that can block other debt from coming in. So if you need the liquidity of a line of credit, well, you got to get all the people that have the secured convertible to sign off on that. Well, that just takes one person. So the more complicated you make the structures, and there can be reasons for that complication, but the more complicated you make the structures, the downstream, it has downstream impacts. So you want to mitigate your risk, but you also want to watch out for those downstream impacts that might make sure that the company can never get any other funding, from anybody else, which is generally not what you want. So that would be my only comment on the preference of type of paper that you're using.
Yeah, that's awesome, Bryan. There was a question that came in. I'm gonna just put that on the back burner for a moment. I want to just keep your riff going there. It's a nice tune you got strumming. You mentioned the shred part of it. I wonder if you can unpack part of that, where the shred plays in, and maybe Venbridge and its overall services within this topic that we're talking about here.
Yeah, so shred tax credit, basically a big lumpy government receivable that you accrue throughout your fiscal year if you are doing, I'll say, my recovering shred partner hat is going to yell at me, but basically, if you're advancing the state of the art of technology, it's a little oversimplified, but if you've got engineers that are working on problems that basically make the entire company swear and nobody knows how to fix it, you probably have some shred. So you're a shred provider that does the writing. I don't do that. Venbridge doesn't do that, but I believe it was BDO that's a partner here. They do that, and they do it well. They can quantify the amount that you've accrued throughout that fiscal year. And as long as you know what you've accrued, and you've got a bit of a history with claiming that and getting it back, and you're entitled to that money back, it's not a grant, so it's not somebody like me sitting in the back room going, I like that company or this company. It's an entitlement. It's receivable. So like factoring AR, it's something that you can borrow against. And that's what Venbridge does. We take that big lumpy asset sitting at the back end that could be, you might be looking at 18 months before you can actually realize that asset and bring that forward as usable cash flow within the fiscal year. We need you to file your shred eventually, and we need to get paid out. It is debt, but it's tactical cash flow smoothing, and soon, hopefully, as of last week, we have our second reading in the House of Commons of the clean tech tax credits, which are for CCUS and clean tech. Those two have gone through. So I'm hoping that within the next week or two, we actually have the final legislation of those two. Those also become tax credits. So, if you've got operations and companies in the north that are buying batteries, panels, wind, putting in a CCUS, direct air capture plant, the capital asset is generating those tax credits, and we could theoretically fund those. So it's not a line of credit, but there's a lot of different other assets that either alternative lenders like us or banks in some cases, depending on the company, can finance to support cash flow and liquidity and just help manage the capital needs. And lots of use cases from just bridging to a next round to I'm seeing a lot of use cases where it's like, I have to buy components for my batteries, and my lead time just went from 3 months that I have to put the cash outlay in the order for to 12 months. How do I cash flow that gap without giving away all my equity? So that's what Venbridge does, but it's part of that overall capital strategy that I think it has sort of rebalanced from just equity with a little bit of debt at the early stage to a much more considered approach. The Tetris game is got a little more complex, but it's good.
You're on level 100 of Tetris. You need that long block to land.
And we're
Clear some
introducing new pieces as the clean tech tax credits come in. So I don't know what that one is, some weird cross or something. Anyways.
Yeah, no, that's awesome. Bryan, you mentioned something, and Don, I know we've talked about this a lot, like the bridge. You know, you're seeing a lot of clients that are coming that are having to do bridge financing because of, well, a whole bunch of factors. Maybe if you can share what you're seeing, what you're hearing, and you know, maybe the conversations that you have with the existing investors, maybe newer ones that are participating for the first time in a company that hasn't gone in the linear fashion of their raise, and they're having to do more bridges and coming back to rather than growing as they thought they would have.
Given the news this week, I hesitate to use the analogy, but you know, the first thing to know about a bridge is that it can't be a bridge to nowhere. And so it can't be just we need more money because we just need more money. It has to be to a rational outcome that seems reasonable. Like, hey, we've got a term sheet where we're going through due diligence. We need, you know, a month's cash runway to just smooth out, you know, keep payroll going while we finish closing this round. You know, we need a bridge to get to that big payable that's sitting over there a month away, but gosh, we really are going to be eating a lot of craft dinner until that time, unless we can, bridge that gap there. And what I'm seeing is like the components being ordered. There's a lot more exogenous shocks, so shocks from the outside that are stretching the cash flow or the cash position, the cash reserves of all the companies that are out there, whether it be SaaS companies, people not renewing on an annual basis, and now it's monthly, and now they're not getting those big lumpy one-offs a year that used to smooth out some of the cash flow, to rounds taking twice as long to finish because there's not the sense of urgency of, oh, I'm going to miss this deal, I need to get this done. So it has to be a bridge to somewhere. There's I think more reasons than ever to have that bridge out there right now, because there's certainly a lot of things impinging on that cash position.
Yeah, just my comment on the bridge concept. And again, for those who might not be familiar with the venture capital industry in terms of, typically what a Series A investor would look for, is there needs to be, some sort of meaningful annual recurring revenue element for a Series A. Like they look for the validation in the market. They look for a variety of factors. And I can tell you that the valuations as a multiple of ARR in a Series A round are typically lower than it would be on the seed, right? Because they have a bit more history, a bit more confident and comfort. So you get a bit more pressure. The problem is that when you, not problem, I guess, but the trigger for the bridge typically is you raise your angel or seed round. And to Bryan's point, things just inevitably take a little bit longer. And you won't get the attention of a Series A VC until you have something meaningful in terms of an ARR. And again, I know I'm generalizing, and sometimes generalizing is a bit reckless. But the seed is often triggered where you're on this path or a bridge to a destination, as Bryan alluded to, and it inevitably takes a little bit longer. In fact, we're about to close on a bridge round right now. And what was interesting, it was more of a defensive strategy by this venture, that it has taken demonstrably longer than they anticipated. And by that, if you look at their planned forecast, like 3 years ago, they're 18 months behind. Like they're almost 50% variable in terms of where they thought for a bunch of regulatory reasons. They can't get the attention of a Series A. Because the Series A is like, look, this is not what we do. Our portfolio thesis is not to do what you have. So they then have to go back, and you can call it a bridge or a new round. There might be different terms, but typically from the seed to the VC, the Series A, it's a function of the ARR. And most Series A needs to see something more demonstrable. So you have these bridges popping up. Sometimes we use a term, other times it's new terms, and we're going to get in there. We'll do it as a convertible non-value note if it's still pre-revenue, pre-capitalized. But it triggers those discussions, and it's usually, again, as Bryan hit the nail on the head, you need to have a direction, and inevitably it's just because something is taking a little bit longer. than you anticipate.
So from an upcoming blog post, I'll throw the image out there. Breaking image, hasn't been used before, but if your gravestone, or where is it? Gravestones before your milestones, you got a problem. So it's getting to that point, as Don says, that you hit those milestones and can raise that next round.
Yeah, absolutely.
Awesome. Yeah, love the background. Just going to pivot a little bit. So we had a question come in from Rick about how would someone go about approaching an angel to understand the process opportunity from an entrepreneur perspective. So maybe I'll answer that question, and then Don, I'm going to put it back to you around something you said earlier. But the easy answer, Rick, is to engage with me through the Northern Ontario Angels. Like I mentioned earlier, go into the website. There's an entrepreneur intake, gives you a 40,000 foot view of your company, where you're at, and will help shape our conversation. And part of our suite of services is to help entrepreneurs, founders become investor ready. So we can help you out with your pitch deck, your business model, look at your financials. And you may not be investor ready, it might take a little bit of time, but we're proud of the partners that we have. So if you're in Sudbury, we would refer you to Don's team at NORCAT, or maybe the Regional Innovation Center, or our communities invested in the innovation quarters. A whole bunch of different suites of services out there within our region that we'd be happy to refer you to, and make sure that you're getting the right services at the right time. So that's probably the easy answer. But you can find our information online, www.northernontarioangels.ca. Rick, this might help you out in your question with what Don had said earlier around he was willing to share his qualifiers for a pre-seed opportunity, or a seed opportunity, rather, my notes say. So Don, maybe you can help Rick out with a bit of a vista of what you would look at from an investor standpoint.
Yeah, no, it's probably my favorite question. And this is something that I think all angels would unapologetically agree with. At the stage that you're approaching angel and or seed capital, unapologetically, we as investors are the number one criteria I look at is the quality of the team, and not so much, why this in terms of the venture and the opportunity. And yes, things such as, the problem you're solving, the differentiation in the market, the IP, product market fit, those are table stakes. But at the stage that we're investing, and me for personally, the way that I can characterize this is any day of the week, I would invest in an A team with a B product at the seed level, 100%. And if, Rick, if you are, you need to be good at storytelling, but need to know that a sophisticated angel is making a determination based on, the character and capability of the team that they will be investing with. And I say that knowing that without fail, and the same applies to the Catalyst Fund, without fail, given the early stage of, again, pre-revenue, for the most part, pre-capitalized tech ventures, what you invest in from a product perspective dramatically changes within, 2 or 3 quarters, Bryan? You've seen this probably more often than me. And so fully appreciating it, I look at, and again, even with the deals I've went in, does this team have the capability to navigate what is going to be extremely, it's just going to change constantly at the beginning. That's just the nature of what we're investing. And, this concept of, you as a prospective company, when you're pitching to angels, again, get the table stakes clear, get the story down. But I would spend, and I'll characterize this in a bit of an embellished way, 75% of my discussion is going to be learning about you, your interests, your motivations, where you come from, where you're going. How are you going to handle the complexities? How are you going to do the change? What happens if the market is this? It's going to be rooted in that. So, Rick and any others that are looking to pitch, a sophisticated angel, our core criteria with the seed capital fund, the Catalyst Fund that I serve as the managing director, without exception of the 6 portfolio ventures that we have, what the product looked like the day of the investment is nothing like it looks like now, but we bought into the team. And so that's kind of the core, unapologetic, unabashedly core prerequisite that we have. We need to know that you're in and you're committed, and we need to know why you versus necessarily why this. Table stakes come, explain as to why we're going to invest in you. I don't know, Bryan, if you have a different opinion, but
I've just got a really rusty neuron that's kind of dusty in the back of my head, remembering a stat from literally the 2005, the Angel initial handbook, which was a analysis of the failure mode of, I think it was Morgentaler Ventures, and they'd had 200 or some odd failures of their portfolio, and they analyzed, they had enough to make it statistically significant. Hard to say on the, but the failure modes were 10% of it was technology. So it blew up, you only plugged it in, and that was what killed the company. Only 10% of the failures were the technology. 30% was the market. You had nanotechnology in 2005, and nobody figured out how to actually do anything with that till 2020. And so the market wasn't quite ready for your technology. And 60% team, 60%. And I still think that was, and I'm sure there's been updated versions of those statistics. But that, back in the day, that was the statistic that always struck me, and it has always turned out to be true, and probably, as I say, understated the value of the team. And the only other thing that I'll throw out for the previous question, actually, is do rely on your local group. It is a heck of a resource, and especially rely on it. I mean, there's lots of the tech crunches, even the beta kits, and I love them dearly. But money is regional. You might go get money somewhere else too. That's fine. But when you read TechCrunch articles and you think all the companies are in New York, Boston, and New York and California, and those are the valuations, that can set up really unfortunate expectations on an entrepreneur's side as to how companies are valued, how the process is done, and there is regional market variance as in all of this. So having that local calibration as to this is what our folks are interested in investing in. This is the type of technologies that we have expertise in, and we're really comfortable in these areas. But medical devices or what have you is we just don't have that expertise. Which is not a comment on NOA. I have no idea. Current the membership's changed a lot, but having that local flavor amongst those 8 chapters is really valuable as an entrepreneur.
Ian, can I just add a supplementary that I think is really interesting, and it kind of dovetails back to the concept of fatigue. The one thing I will say, and this is maybe a nuance to the Canadian, I'll say angel and maybe the venture capital industry, is it raises eyebrows if you, as a startup tech venture, convey to the broader investment community, I'm out, I'm going to start raising capital. And again, I don't know, we could debate exactly what it is, but I would say somewhere between 9 and 15 months. If you don't close that round, people are going to get suspicious as to what's not right. And so if there's one thing I can convey is, get the right pitch coaching. Again, the table stakes, and there's lots of entities, NOA, NORCAT. There's a whole bunch of innovation centers that can help you structure the table of contents and build the story. And make sure it's authentic and meaningful, knowing that a prospective angel is looking at you as an individual or your collective team and the capabilities to navigate it. And one of my I don't even know how to describe this without getting agitated. In the term of authenticity, it is important that you focus on, as a team of, as part of a startup venture, you need to focus on building a great company. And I love that background, Bryan, that you had a moment ago. One of the biggest prerequisites that I looked at and continue to do so as part of the seed fund is, what are the milestones that you are going to set out to achieve? That milestone thing is brilliant. What are the milestones you're going to achieve versus some of these angel prospect deals will come to us and say, well, here's going to be my seed round. Then I got my Series A is going to come in this date. Then my Series B will come in this date. I'm like, where's the milestone achievements? I don't care about the rounds. I don't care about the timing. Yeah. I want to know how this team is going to deliver on what milestones that are authentic and reasonable. And let's talk about the timelines to get there and why you need this money to do that. Yeah. And how is it going to be? So it's just the Canadian landscape is a bit unforgiving because it's so small. And when you raise your hand and say, I'm out, the world knows. Canada knows. It doesn't take long to know that you're raising capital. And I don't know, Bryan, I don't know, maybe 15 months is being, I don't know if it's being aggressive or if it's being conservative, but I can say if I see a deal that's been working on a seed round for over a year and a half, I'm like, something's not right.
I would agree. I might temper it a little bit, just in terms of the last year, because it's just been so tumultuous, the markets and everything else. But yeah, no, I mean, there was a time where it was 6 months, and you kind of went, "Well, why haven't you raised it?" So the best companies have always, I have found, have engineered things so that it is the overnight success garage band that they've been working in the background on it for the first 12 months, slowly getting to know the angel community or the venture community, and keeping them abreast of what's going on as they hit those milestones. And by the way, raising money is not a milestone; it is a part of the path. But the milestone is the traction, the customer, the sales numbers, whatever it is. It's real business achievements that are then fueled by that cash down that road. So yeah.
I love it. And we're going to get to our final question here and look to wrap up at around 5. But just wanted well, thanks, Bryan, for mentioning around the regional part of it. I think part of the success of Northern Ontario Angels is that we haven't really been prescriptive on our deal flow. We have a bit of a broader funnel. We've been reactive to our investors. So we've been quite nimble, and we're afforded that luxury of nimbleness through our funding partner, Fedmore, to be able to say, hey, we've got these consultants all across the region. Each community is a little bit different. They have different features within their deals, but we're going to find the people to pair you with so that we can find that capital for you. So that regional part of it, I think, is definitely a feature that hopefully it differentiates us. I think our numbers would support it. Don, around the team part in the feature, I reflect a lot around a conversation I had with Joe Eibel, the founder of Flowsonics, where he said, the team, the idea, the flow patch, 1% of it. It was building the team. It was, connecting with the right people, getting the right advisors, getting that smart money from the beginning in terms of some of their investors. And of course, everyone's going to have their own story as they scale and grow, and there's no perfection within this world. But when Don or when Joe mentioned that to me, and I like, yeah, come on, Joe, you're that's pretty modest. 1%. It's a hell of an idea. But that's part of the compelling thing of working with somebody like a founder like that, who's humble, and you can appreciate where he's coming from. So I agree 100%. At this stage, it's really about the team. And maybe just to add to bookend on what Rick's questions were, when you engage with us, we're going to make it really hard on you. We're going to see if you're coachable. We're going to see if you're going to come with humility and humble inquiry and around where you're going to go, and that's part of becoming investor ready. So Stephen, you've been super patient. You kept your camera on, pulled over. You had a question in the chat here. So you're a small business, slowly completing expansion of your products across the country, starting to get into the US. How do you identify quality partners to assist and help with that expansion? Do you mind going off mute for a moment and maybe sharing with Bryan and Don a little bit about more briefly around what your expansion looks like, and maybe we can help you with some focus responses. Sorry, man, I put you on the spot.
Yeah, all good. Can you hear me?
Yep.
Yeah, so as I mentioned, we're about a 3-year-old business. Came about through the COVID sort of times. We started off just supplying stone products to the mining industry in Sudbury. That's led to some products that got carried national by Susie Cello and a few other local partners. That then allowed sort of funding, I guess, to create some other products that have been successful, and they're continuing to push them nationwide. So that's been relatively easy, just working with vendors in the area that we knew already existed and already had connections in the mines. We can talk to them, we can see them, and then they have the connections to the people that already know the people in the mining industry and in other industry. So when we're reaching further afield for people that we can't pretty much walk in and meet, it's where we're kind of hitting a bit of a roadblock, as in how do we make that leap, finding quality people that we can work with.
And just for clarity, what type of product is it?
They're like industrial sewing products.
Industrial.
Industrial sewing products.
So okay, cool.
So like pouches and backpacks and that kind of equipment. Yeah, it's not tech based. Sorry.
No, that's
That's
fine.
cool. All good. Yeah, I think an easy answer and going to create work for Don and his team. It probably go through a registration process through the NORCAT innovation team. We can get a little bit more knowledge around what your product is, where you're at. Sounds like you've already got it on the shelves, but what NORCAT has that I think differentiates it from some other organizations is an incredible mentorship board, people that have industry knowledge and get a snapshot of your company and then probably provide some advisory services to you to see where you can expand. Don, is that fair?
Absolutely. And as a preface to that, Stephen, it's interesting from a shared experience, within NORCAT, we actually have some for-profit competitive companies that we own. And, we have tried, some successful, some not, various market entries into the American market with I'll call it a consumable. It's more of a B2B play than a B2C play, but it's a tangible product, not unlike yours. And what's interesting is we did a fairly robust assessment on, where's the product market fit, where are we going to go, where are we going to play, what's the target demographic, and then, getting clarity around that, especially based on your credentials already, is really important. But then understanding, do you want to go bricks and mortar with a dedicated sales force? Do you want to go third-party distributor? Do you want to go ship from Canada into retail in the US? There's a whole series of different options, which I'm sure that you've probably explored. But one of the interesting things, and again, Ian's right, we do have some advisors with pretty interesting experience on, how do you de-risk, how do you evaluate, how do you structure, this could be to me, it sounds like almost like a distribution opportunity. How do you structure all these deals? And so, yeah, like I could think of numerous people. I'm working with a few companies right now on a distribution agreement for the African market. And the complexities associated with getting it right is interesting. Others are looking at, we have another client that's doing Latin America bricks and mortar. They're going to build their own sales team. They're going to do their own direct in market. But the process in which they use to evaluate what was right for them is quite interesting. So happy to help on that.
Yeah.
Okay.
Only other thing I would throw out there, and I would say, Don, step first, absolutely. And if it is appropriate, potentially trade commissioner service, once you've identified those markets and how you want to go there and what it is, trade commissioner service and people that are in market there in that region, and EDC can sometimes help with some of the financing tools that they've got. But you have to know where you're going and why you're going and which tools you're going in with. Before you can really you leverage those tools. But they've actually, depending on the region, I've been surprised. I shouldn't say I'm surprised. I have been really pleased to see the networks that some of the trade commissioners have in some of the regions and some of the stuff that they can bring to bear.
Yeah, I think that's why I wanted to ask the question of you guys. Obviously, massive experience doing exactly this. And it's amazing when you talk to people, the connections already exist. Rather than cold calling a million people through LinkedIn, it's
yeah. Blunt force. There's probably an easier way with less brain damage than the blunt force way, but maybe not. I mean, it depends. Sometimes that is the road to go.
Yeah. Stephen, if you're based in Sudbury, Ian put the link in. By all means, reach out or however we can get connected. There's a handful of us within the innovation team that has good insight into market entry, especially into the United States, and have lessons learned that I think might be helpful.
Yeah. Okay. Awesome. Okay. Thanks for your time, guys.
Oh, thanks for the question, for logging on. And so, speaking of time, we're right at the top of the hour. Sorry, there's some questions that came in here. We'll record those and respond back to you outside of this forum. But thanks, Don. Thanks, Bryan, for this great conversation. we'll be doing some more of these, and may tap you on the shoulder again. And really happy with how this turned out. And thank you everyone for finding time right before a long weekend. And hopefully everyone is safe and enjoys their time with their family. And thanks for logging on.
Thanks for hosting. This is fun.
All right, thank you. Thanks for the opportunity. Take care.
Thanks again.